Arnie, let me bring you back in. You run, this is a slightly different subject, but I'm always fascinated with it. You run the Emerging Markets Carbon Reduction and Climate Improvement ETF. That's a mouthful, but the symbol is EMCR, and it basically tracks an index of emerging market stocks that are selected based on whether or not they're reducing their carbon footprint. It's sort of like a play on the net zero economy. But prices for these carbon emissions have collapsed. This is interesting in light of what's going on in Ukraine. Can you explain why that's happened and what impact has this had on the whole movement towards lower zero emissions?
Yes, Bob, this is actually a very interesting topic to bring up in the current sort of scheme of things. The topic of carbon reduction and climate risk, obviously before the most recent incursion onto Ukrainian territory, was really at the top of the agenda for many of our investors. EMCR is a fund that was launched relatively recently. In August of last year, we brought it to market. In a relatively short period of time, it managed to gather over $700 million of assets from institutional investors. So that goes to show that really there is demand for that kind of net zero type of carbon reduction strategy. And what EMCR does, it's not a thematic ETF. It's not an ETF that banks on, let's say, carbon efficient industries in any way, but it is very much a broadly diversified emerging market index that really seeks to track in a way any market capitalization weighted index. However, it also at the same time seeks to reduce the carbon footprint by 60% and have a year-over-year carbon reduction inbuilt to itself by 7%. So it is really something that, especially in the institutional investor community, we see at the top of the agenda. Of course, with recent geopolitical news, that agenda has shifted somewhat, very understandably. However, in the medium term, and most certainly in the long run, the topic of climate change and carbon reduction and the importance of carbon reduction strategies will for sure come back onto a broader agenda. I'm personally relatively sure about that.
So it feels like a double whammy here. I mean, I'm looking at what you own: Taiwan Semi, Tencent, Samsung, Alibaba. They've all gotten hit in the global slowdown, number one. But number two, I mean, prices for the carbon emission business in general have collapsed a bit because of what's going on in Ukraine. The emphasis is going to be on hydrocarbons now in the near future. I got that. So that's the two-pronged problem here, Arnie. Is it right? Am I right about that?
So just to avoid confusion, we're not actually trading any carbon credits or futures on carbon credits in our product. We just hold stocks. We're a long-only portfolio of emerging market companies. And yes, of course, that portfolio has suffered alongside the standard market cap benchmark. However, since its launch, we've actually seen a fair bit of outperformance, ever so slight outperformance, I should say, of EMCR compared to a market cap weighted benchmark index. So the suffering in terms of the carbon price has no effect really on our portfolio. We're still exposed to companies that have a plan to actually better their value chains for the purpose of medium-term climate change.
And is this going to change the whole conversation, the Ukraine thing, around a whole environmental discussion?
It should. I mean, ag tech.
I'm talking about ESG in general, but the E part of ESG.
I think it adds to that. I think we're going to be obviously, I think we're going to be not using Russian wheat for a long time. That's just my opinion. So you're going to have agriculture and carbon credits in agriculture is a huge trend. That's going to be part of ESG. We'll be talking about that next year like it's the biggest topic around.
Yeah, I don't know where that's going to go, but it has to affect the whole ESG story, the whole environmental story somehow,
absolutely.
And the investing in ESG.
Yeah.
I mean, it always amazes me that when you look at these big ESG funds, they're always tech-oriented because, in a sense, they're like large growth companies.
Right. How do we get rid of this? How do we get rid of that? How do we stop doing this? That's what they're about.
It's very, very difficult.
Yeah.
Charles, any other thoughts on what the retail investors are telling you right now, what your members are really interested right now, other than trying to figure out what inflation is doing, which we all want to know?
Yeah, and the one nice thing is a lot of our members tend to be long-term investors. So I would say the one thing we do have, particularly among our members who are retirees, is really just that income portion of the portfolio. That's been a challenge for years, as you know, with interest rates being so low. And it continues to be a challenge. So while they might be worried about the impact of interest rates on the stock market, they're also somewhat relieved that at least, on the income side of their portfolio, they should be getting a little bit more in. And I do think there's a general sense that the Fed needs to raise rates just to combat inflation. But that is something they're definitely paying attention to. What are yields? And when can they be in a situation where perhaps they can actually count on something besides dividends to give them a reasonable yield and some cash flow?
Yeah, it's been noted. I've done several stories on this year. Record dividend payouts in 2022, it looks like. Record buybacks, it looks like. Record cash flow.
Yeah.
I don't know if capital expenditures is going to be in a record. That's what a lot of people would like to see. But certainly companies like the oil companies are going to get oceans of cash flow.
But there's risk. If you look at the HYG and the J&K, to stay on the ETF topic, outflows. There's, higher yield, more risk.